Hello, good afternoon, everyone. Thank you for joining our session today on adaptation financing reimagined. A great topic for which we're very passionate about. And as an MDBs, as a joint group, we really wanted to have an opportunity to share with you of all the different instruments that the MDBs are deploying and using to support adaptation. I would like to first invite Dr. Youssef Nasser, who is the director of the Adaptation Division of UNFCCC, to give some opening remarks and help us with the scene setting, and then we will move into a panel discussion. Thank you.
Thank you, Julia, and thank you to everyone who's here. This is a nice respite from the negotiations going on, so I'm very appreciative I was invited to escape my main job for a while. And so I'm the director for adaptation at UNFCCC, and we have multiple negotiating items on adaptation under consideration now, some going faster than others, but in the end, you'll always find some link to the finance discussion in any adaptation agenda item. It's always lingering there, either directly or indirectly, explicitly or implicitly. So that's the interesting landscape we are here considering. The COP is full of talk on finance. There's the NCQG. There's a lot of other things. It's dominating. But also beyond the COP, we've had calls for reforming MDBs. The Secretary General has called for reforming the whole international finance system. We don't really know reform towards what. We know that it needs to be reformed. It's like the IPCC told us you need to transform, both in Working Group 2 and Working Group 3, but not reform or transform towards what landing zone. And so here's where intellectual discussions like this come into play. The scary part of this is, if you're following the UNEP gap reports, is that adaptation is poised to cost something in the range of $400 billion a year, or that it already costs that, and the costs are being borne mostly by those affected. And we don't expect public grants to be elevated to any order of magnitude that can respond to these increasing needs. We don't expect debts to be elevated by an order of magnitude that can respond to these needs without crippling vulnerable economies in the long term, or without exporting the problem to future generations. And so what's left? What's left is the types of instruments that we will hear about today, which seek to fill that gap to a certain extent. Some of them are more operationalized than others, and there is a need to push that intellectual boundary and identify new and innovative financing modalities, even beyond what we will discuss today, in order to see how we will bridge the gap. Otherwise, we are just taking a conscious decision to let people die. So we will hear a lot of very good interventions today. The MDBs are uniquely positioned to break these intellectual boundaries we've talked about. MDBs have the expertise and the experience in dealing with countries on climate change, on adaptation as well, and a very close relationship with the countries to understand the nuances and the distinctions and context specificness of the types of needs and the types of absorptive capacity to these different interesting instruments. So we look at resilience bond, we look at guarantees, we look at climate resilient debt clauses, we look at adaptation benefit mechanism. And I consider this to be a foundational discussion, an incipient intellectual sparring that would serve as a springboard for us to do even next level intellectual work and devise new amalgams of existing instruments, or even new modalities altogether. So we will hear now how we have imagined a lot of new and very impactful modalities and channels for support that can work really well with adaptation finance. And the next step will be how to reimagine modalities even beyond these as we move forward. So with this, I won't take any more of your time and wish you all good luck. Thank you very much for having me here and best of luck to the panel. Back to you, Julia.
Thank you very much, Yusuf, and thank you for setting the scene on what is it that we're trying to do here today, and that is indeed to showcase what the NDBs are capable of, and that we are actually in the very right position to deploy those innovative financing instruments and help the countries to go beyond the regular financing of grant and loan. So here's what we are here for today to discuss that. And I would like to first introduce the panel, a very esteemed panel today with a representative from EBRD, MIGA, IDB Invest, and AFDB. So I'll start with Helen on the side, Helen Mirovic, who is the head of climate in IDB Invest. Next to me is Giampiero Nace, who is the director for sustainable business and infrastructure in EBRD. And on my right side is Yasser Ibrahim, Senior Manager for Sustainability and Climate in MIGA. And we have a representative from African Development Bank, Gareth Phillips, Manager, Climate and Environment Finance in AFDB. So indeed, we have all the MDBs represented here who are very active on adaptation financing and have experienced different and interesting experiences to share with us on what they do in this respect. So I'll start with Giampiero, perhaps, if you could speak to what EBRD does in this space, and particularly maybe if you could mention some of the innovative instruments with regards to sustainability-linked loans. And we also know that EBRD was the first NDB to issue a resilience bond a while back. So maybe you could share us some of the motivations behind coming up with these interesting financing approaches for adaptation. Thank you.
Thank you very much, Julia, and good afternoon, everybody. So let me start perhaps with a small context point. At EBRD, we're a private sector focused organization. So 80% of our finance is actually delivered through private channel. So for us, adaptation finance, it's something that is a priority, something that we really promote, but it's not easy, and in fact represents still a relatively small percentage of our total climate finance. And it's particularly difficult also to attract private investors, and private capital towards adaptation projects. We're doing all sorts of things to try to address the problem by, for example, enhancing the way we look at socioeconomic benefits of the investments we do. We try to link a lot, improve, enhance resilience with competitiveness. That's actually starting to resonate, for example, with a lot of organizations, operating in the agri-food space. But I must admit that, it's not necessarily an area where we can show, huge numbers, even though, happy to announce that, this year we're going to allow a record adaptation finance. So we're going to get closer to 1 billion. We're not there yet, but it's significantly higher than our average. At the same time, we're again looking at all potential avenues to create, market instruments that can, mobilize more climate finance, and that was the main principle, the main motivation to look into, capital market instrument that can diversify the offer in the market, but also potentially attract interest from private investors. So we worked in 2019 with the Climate Bond Initiative to develop a set of principles and criteria that could be applied to a climate resilience bond issuance. And that's what we did. In 2019, we issued the first bond, which was $700 million. And this was based on our portfolio of climate resilience investments, primarily infrastructure projects delivered both through state-owned utilities and entities. 20% of what we finance is still in the public sector, so we have a portfolio of public sovereign assets, but also through sub-sovereign entities like cities. So a lot of municipal water, wastewater treatment facilities, and indeed projects to reduce water losses, for example. But crucially, we brought to the table and to the portfolio also a significant share of investments through corporates in industry, like zero discharge water interventions, moving from water cooling to air cooling type of systems, and also in the agri-food supply chains. The project we do with corporates that operate in the agri and food space. And ultimately, we set up a new process internally to identify these investments, to really try to assess upfront the expected resilience outcomes, and which is a process that we still apply, which take into consideration, of course, our environmental and social safeguards, but also introduce other characteristics in terms of prioritizing those investments ultimately lead to a significant impact. And the experience has been very positive because, first of all, and again, we do these kind of things under, two main drivers. One is, of course, also to diversify the type of instruments we use to fund ourselves. Ultimately, BRD, as all the other MDBs, we fund ourselves in the market, right? But also to bring to the market a new instrument, something that can be also deployed. That was the intention, and still is very much the intention, to deploy through our client base and to the countries where we operate. Ultimately, the reception was very good, so it was fully subscribed. And interestingly, it is a product that gave us an unexpected exposure to some of the investors. I'm talking about pension funds or impact investors that wouldn't necessarily look at EBRD as an exposure, right? But we're actually very interested in this product because it was innovative at the time, but also because they wanted to build a portfolio of financial assets with a strong resilience outcome objectives. So that was a benefit for us because clearly the more diversified investor base, the more credible we become in the market, and perhaps also it's a way to strengthen our credit profile.
Thank you, Giampiero. Great experience, and I think what we would like to see is more of these type of initiatives and more of the MDBs to issue thematic bonds that are addressing resilience and adaptation. And we know that there's a lot of work that has been done with CBI now as well to create a taxonomy. So I think that will be a critical tool that will help to drive more of these type of projects and bring this interesting initiatives to the market. Moving on to my right side, Yasser, maybe you could speak to, we know MIGA is very active in deploying the guarantees and therefore bringing in the private sector and helping to overcome the investment grade barriers in the countries that you are working in the emerging markets. But what is MIGA doing explicitly to support financing adaptation projects? Maybe you could share some of the examples. That would be very interesting.
Thank you, Julia, and good afternoon, everyone. Happy to be here today. So I'm really with our fellow colleagues. So really thank you for the opportunity to share with you what MIGA does. So perhaps I'll start by explaining what MIGA does, because sometimes people really are not aware of what is it, what is a guarantee, and how does it work. So MIGA is the political risk insurance arm of the World Bank Group. So MIGA was established to really promote foreign direct investment in our member countries. And that is really through supporting lenders and equity investors in our member countries. So private sector lenders who are either providing loans to other private sector or to the government, or equity investors in our member countries. So it has to be FDI moving into the country. So we've been working on the adaptation side, particularly through what we call non-honoring of sovereign financial obligations. So basically, this is when the government is borrowing money from a private sector to set up a project, an adaptation project. So to give an example, for example, in Serbia, the government was borrowing money from 6 banks that were worried about some of the risks that the government can go through. So that's why it's called non-honoring of sovereign financial obligations. The other covers that we cover is political risk insurance. So basically risks against expropriation of assets, risks against war and civil disturbance, or transfer restriction or breach of contract. So through the non-honoring of sovereign financial obligations, this is when the government was borrowing the money to establish this road in Serbia, as well as river waterways. So we covered over 900 million of loans to the Ministry of Finance so that they can work on these things. And we've had several projects that had to do with dams in other countries and things like that. So the public sector works in the adaptation field perhaps is well established. And to an extent, this is where MIGA comes in certain countries to help banks finance the ministries throughout these aspects. The innovation that we started looking at last year is how can we work with other partners to mobilize private sector. So we've been doing some works with regional development banks like BUAD in Africa and West Africa, as well as Banco do Brazil in Latin America. And throughout the work with these banks, we've been trying to see, okay, what can we do with small and medium enterprises? How can we work on the agribusiness space and increase, particularly in regions where there are water scarcity, there are lots of issues there. How can we increase the capacity of our financial intermediary clients? Because most of the time, MDBs cannot really do everything on our own. So we really need partners. And our partners are the financial intermediaries on the ground, be it the regional development banks or the banks that are operating in our member countries. So we've been doing that with these two banks, where we were able to deploy around 1.2 billion in Brazil for nottle farming, as well as around 600 million euros in BUAB. And throughout these two projects, we've been working with their smart agribusiness to see, okay, what is needed? How can we help them help their clients better understand, smart agribusiness, better understand water efficiency uses, things like that, so that we can address adaptation needs in these countries. So this is one of the new innovations that we've been doing, working with financial intermediaries, which for us, we are hoping that we can expand more. We are looking at other partners where we will be working with them on more aspects of adaptation, particularly since we started applying our Paris alignment methodology that all of us have been working on. So adaptation and resilience is really one of the key elements for us, working particularly with what we call counterparties. So how can we help our counterparties understand the risks in their lending processes and then develop systems that can help their clients address these needs? So resilience for us and adaptation is really going to be key going forward. So let me stop here. I know. Thank you.
Thank you. Thank you, Yasser. Very interesting. And I think we all as a group of MDBs can concur to the fact that Paris Alignment commitment that we have all agreed to adhere is indeed helping to transform the financial intermediaries and the clients that we work with globally. Moving on to Gareth, AFDB. We know AFDB has a very interesting adaptation benefits mechanism. Maybe you could speak a little bit more about the innovation of this product and what is AFDB doing specifically in this regard. Thank you.
Great. Thank you very much, Julia. It's a pleasure to be here. Thank you for inviting me indeed. I see that Yusuf has just left the room, but I wanted to say that we've been having a lot of intellectual discussions already, particularly around Article 6.8 of the Paris Agreement. And we've actually progressed from those intellectual discussions to create a new modality, which is the adaptation benefits mechanism. The challenge about adaptation and many of the instruments that we're hearing about, the guarantees and the bonds and so on, the challenge for adaptation is that many adaptation projects don't have cash flows. You're delivering public goods. For example, if you're controlling floods, you can't collect revenues from those kinds of activities. And because of that, these projects are unable to access the capital markets in the first place. And so if you can't access the capital markets, you can't take advantage of guarantees and green bonds and insurance mechanisms and so on. And we rely on grant. And as Yusuf said, we know that there is insufficient grant funding available, and we have to find some way to raise additional finance. Now, I'm going to make what's usually the point that I make right at the end, but it's so important I want to make it at the start, and I might repeat it at the end. At the moment, emitters globally are getting a complete free ride on adaptation. They are paying for mitigation through things like the emissions trading schemes and cost reflective tariffs and the cost of renewable energy and so on, where that's more expensive than fossil fuel. But nobody is paying anything towards the cost of adaptation. And every single ton of greenhouse gas emissions that we release to the atmosphere has an impact on adaptation needs. And I think that we are missing that in the negotiations. I think the developing countries are not asking or requiring developed countries to start to make this contribution. contribution. So even if every country, every emitter in Europe agreed to pay $1 per ton of CO2 that they emit to the atmosphere, that would be $2.5 billion a year coming into adaptation. Now, you might think of it as grant funding, or philanthropic funding, but it's new money that would be coming into the process and that would go to private sector project developers that would stimulate a great deal of further investment. So that's really where we need to get to. Emitters need to start contributing towards the cost of adaptation. Now, let me tell you a little bit then about the adaptation benefits mechanism. The ABM is designed to provide a cash flow to adaptation project developers. So these are the micro, small and medium enterprises in Africa. According to NEPAD, there are 44 million micro, small and medium enterprises in Africa. We focus in Africa because we're the African Development Bank, but this is a global instrument. It can be applied anywhere. So it's to help these enterprises access revenues. And we do that by enabling them to generate what we call certified adaptation benefits, or CABs. Now, what is a CAB? A CAB, first of all, it's a quantified and certified record of outputs, outcomes, or impacts of an approved adaptation project. And when I say approved adaptation project, it means a project that's registered under the ABM mechanism, so it follows the project cycle, and it also has host country approval. And that host country approval is really important because it kind of closes the circle, and in the end, the money that's spent financing that can then be declared under the Enhanced Transparency Framework, and it makes the ABM part of the negotiations under Article 6.8. So that approval process is very important. Certified adaptation benefits are project specific. They're not fungible units, not like carbon credits where they're all the same from lots of different projects. Each project generates its own certified adaptation benefits, and then we'll find that there's replication and you'll get the same project using the same definition. But we might end up with, 30, 40, 50 different definitions of adaptation benefits. So they're not fungible, which means they're not subject to speculation and trading. And that's really important because it means the financial model is quite different. And I'll say a little bit about that later on. The certified adaptation benefits are designed to be purchased by emitters and then surrendered and reported through governments into the Enhanced Transparency Framework. So a government could say to all of the emitters in their economy, we want you to spend $1 per ton CO2 emissions, purchase your adaptation benefits, then redeem them and cancel them, claim them and send us the receipt. And then we're going to add that up and we're going to report that as our contribution, our economy's contribution towards adaptation needs. And it's going to be a very long list because they might choose 100 different countries to invest in, doing 100 different projects. So it's going to be really messy. You're not going to be able to add it up. But the one figure you will have is the total amount of money that this economy has contributed towards genuine adaptation needs in developing countries. And the final point about an adaptation benefit is that because they're not fungible, there isn't a benchmark price. And that means that we price them on the basis that the pricing closes the financial gap in the project. So if you need $1 million to make your project viable, then we price the certified adaptation benefits to generate $1 million. And when you get your $1 million, you then stop. You don't generate anymore. So it is a minimum concessionality model. And that's really important. That's because it's a non-tradable instrument. Tradable instruments like carbon credits drive a profit maximization model. So we're talking about a minimum concessional requirement. And that is a much more efficient use of scarce capital to invest into these projects rather than driving a profit-driven model in the carbon market. So we think this is part of the intellectual work we've done around the difference between Article 6.2, 6.4 and non-market approaches under Article 6.8. And I think it's hugely underexplored and we should really be doing a lot more intellectual work to understand the potential of these non-market approaches. Can I carry on? Is it okay? Yeah. So briefly, how does it work? We have a project cycle. If anybody here in the room remembers the clean development mechanism, and don't roll your eyes, there were some good things about the clean development mechanism. One of them was the project cycle. It was extremely robust. During its 10 years of operation, 12,000 projects were submitted and over 8,000 were registered. The CDM, sorry, the Green Climate Fund has been going for about 10 years and they're on about project 250. Okay, they're quite different and they're bigger. But in terms of reaching out to small scale context specific projects, this is an extremely robust project cycle. So our project cycle is modeled on the same. We have a methodology and then an activity design document that needs to be validated and registered. And then you have a monitoring program and a monitoring report, which is verified to then generate the certified adaptation benefits that are then sent to the purchaser. When you have a registered project, you can put your project in our adaptation supermarket, which we haven't developed yet, but we will eventually. And we'll invite donors and philanthropies and emitters to come and browse the shelves and pick the projects that they like and sign an adaptation benefit supply agreement. So that's like a purchase agreement, and that's your guarantee of finance. With a registered project and a signed purchase agreement, you can go to a bank and borrow money. And those banks would initially be development banks, but if we can put some guarantees in place, then it could also be local commercial banks, and we can do lines of credit to help them lend and so on. So we can create a whole mechanism that allows private sector project developers in developing countries to access the capital markets to build their adaptation projects and then pay back those loans by selling the adaptation benefits to private sector emitters in the developed world. We've been working on our pilot phase now for 4 or 5 years. Next year should be the last year. We've got some pilot projects. We've got some methodologies. We have the project cycle pretty much in place. We haven't yet generated any certified adaptation benefits. We haven't had enough money yet to complete the cycle. We've been really trying to raise money. One big step forward that we're taking at this very meeting is the ABM will be registered on the Article 6.8 platform as a non-market approach. It's just been uploaded and it has to have a 30-day consultation period. So it's not going to happen during COP. It'll happen just before Christmas. And then we will have something to point to help us raise some funding. And in the future, what are we trying to do? Our next step is to try to raise a fund. We want to raise $30 to $50 million so that we can do a call for proposals for adaptation projects. And basically, we would say, look, we can guarantee you a cash flow of $1 million. What kind of adaptation benefits could you offer us for that money? So we will pilot this process. We'll kickstart it. We'll use some money for technical assistance, some for the Secretariat. And if it sounds familiar, it is, because it's exactly the same as the World Bank Prototype Carbon Fund that kicked off the Clean Development Mechanism in the early 2000s. So we want to replicate that model. And then I come back to the first point that I made. The idea is to demonstrate to developed countries that here is a flexibility mechanism that they could use to require private sector emitters to take to adopt targets to contribute towards adaptation. It's not the only way. I'm sure we can come up with other instruments, but this is one instrument that we could use to start the ball rolling. And with that, I'll hand you back. Thank you very much, Julia.
Thank you, Gareth, for your very passionate intervention. And you will have another round to speak more to this if you wish to. So we'll give you that space. But indeed, it's fascinating to hear on something that is creating the capital markets for adaptation, which is really, really missing. And it's great to see that AFDB is working in this regard. Now I'm moving on to Helen for yet another very interesting product, which is called the climate resilient debt clauses. Maybe if you could also shed some light into what it is and how has IDB Invest used them, and how is it helping really countries to overcome the challenges of disaster risk reduction?
Thank you. Can you hear me? Yeah. Thank you, Julia, so much for the question, for inviting IDB Invest to be part of the panel. And I was hoping I was going to speak before Gareth, because he is so passionate that I'll try to keep up with his energy. Before I go into the details of the climate resilient debt clause, let me tell you one thing that it catches my attention from what Gareth said. He said he's been thinking about this, and it's true. He's been thinking, and he's been sharing this concept for quite a few years. 5 years, you said. The climate resilient debt clause has also been in the works for a long time. And I think that what I want to say here and stress is that the adaptation financing products or projects that we're thinking about, it takes time. It takes time, and this is not something that I say it lightly, because you have to channel a lot of resources, a lot of energy, as you saw, to get these products out in the market. And that's something that we have to all recognize, that this is not an easy fix or a quickly replication, one size fits all kind of thing. So that's one thing that I wanted just to stress, because I wanted to talk to you actually about two products. One is the climate resiliency debt clause that we are using in IDB Invest, but also the public sector side is using with public lending with countries, as you mentioned. But I also want to talk to you about the Caribbean Water Utility Insurance Collective, or we call it QUIC, because that's another way where we linked climate adaptation, climate resiliency, and response to disasters. So basically, when we talk about the climate resiliency debt clause, it's a clause that we add to the lending that we do to private sector, because it's a way to reduce the perceived risk that a private sector client may have of future impacts of climate, and that will prevent them from investing. So what we're trying to do is give financial resiliency to a specific project by adding this component to the lending that we're doing. And this is not something that we came up with. This is something that has been used in Peru for quite a while, because the banks seen the impacts of El Niño y La Niña in Peru. So we learned from how the private banks were working in Peru, and we took that resilience clause or El Niño clause, and we started applying it to our lending in the agribusiness sector, mainly in Peru and Argentina. And basically what it is a clause that if there is a national disaster that has to be called upon by a national authority, so it's not the client saying, oh, there is a disaster here, but actually a national authority has to call that. The client has the option to call this clause. And when they call this clause, they stop payments. And so they can use this cash flow to respond to the disaster. That's basically the idea of the climate resiliency debt clause. So we have applied it to the agribusiness sector mainly, and we have started using it for infrastructure, especially for SOEs that are in the Caribbean, because they also need them when a disaster hit to stop the payments of the debt servicing of our loans, to redirect those financial resources to the response of the impacts of the hurricane. That's one of the clauses that we have done for mainly, as I said, to agribusiness and now some infrastructure projects. But we are trying to get data on what other sectors should we be applying to, at least in the private sector. The public sector side of IDB applies this clause to all of the loans since I think 2021. All of our loans, public sector loans with governments, include this clause. And they give a 2-year grace period, basically. In our case, for the private sector, is 1 year. But one of the things that we're wondering is 1 year enough? Should we give more? Should we give less? How do we get the data? We also have to learn from applying this type of solutions and try to see how do we improve the mechanism. The second product that I wanted to talk to you about is the Caribbean Water Utility. And this also has been a learning process that we saw that a lot of SOEs, water utilities in the Caribbean, they are hit by a hurricane and they don't have the ability to have quick cash to respond to the disaster. And so what we came up with is to work, and we started working on this in 2018, and the first payment was done last summer in June 2024. So just to give you the timeline of the thinking, the learning, the design of a product, and the application of the product. And with the Caribbean Water Utility Insurance, what we said is, let's create a water mutual. Let's make all the water companies pay into this mutual. And when there is a disaster that hits, they get a quick payment within 2 weeks maximum. That's the maximum. They have to get it beforehand. But the interesting thing about this concept is that the premium that they pay to the water mutual is lower if they have included resiliency measures after a hurricane hit. So basically, where incentivizes resiliency, the adoption of resiliency measure. Let's not build the same thing that it was before, but actually, if you build it better, you will get a lower premium into the water mutual. So those are the two examples that I wanted to share with you, but happy to continue the conversation.
Thank you so much, Helen. Very, very interesting. Yet another very interesting example, not only on the climate related clauses, but as well on the insurance products. And I think some of those examples on the regional insurances are also emerging in different areas. So it's wonderful to hear what IDB Invest is doing in this regard. And if I may compliment IDB Invest as well, or the whole IDB group, is the fact that you are indeed offering it to so many clients, and sovereign as well as non-sovereign clients, whereas some other MDBs that are thinking about it or still offering it only to sovereign is a limitation. So I think that's really a great effort from the IDB group side on this. So Jean-Pierre, again, coming back to you and maybe wanting to hear some of your reflections, what I have mentioned earlier around the development in the adaptation bond space and in capital markets on adaptation, the recent CBI framework or the taxonomy for resilience bond. Will that help to have more credibility with regards to the projects that are going under those bonds? And do you see this also being scaled up beyond what EBRD has done before?
Thank you, Julia. Maybe before going to your question, I just want to reflect on what my colleagues have just mentioned, because just to give a bit of a sense of the fact that ultimately we operate really as a system, because also the EBRD, following the lead of the Inter-American IDB Invest, actually we are also using these instruments. The work of Gareth in the adaptation benefit mechanism, we are very strong support because we believe in market instruments. And now we've been discussing with Gareth, can we also use this approach, for example, for insetting rather than on top, of course, of potential options associated to Article 6.8. And of course, the instruments that MIGA provides, we're a big beneficiary. And so just to say that, and ultimately going back to the climate resilience bonds, AIB, right? Last year, you issued also a climate resilience bond. So there is a lot of cross-fertilization. And this is part, if you like, of the joint, MDB offering. And I think it's important because, again, we learn from each other, we develop things together, and we try also to harmonize our products. Now, going back to your question, what we've learned in the last few years, first of all, that nothing goes as you predict, right? When we issued the first climate resilience bonds, this was in 2019, pre-COVID. So COVID came, a lot of infrastructure investments were stopped. So we, all of us, we came to the market with liquidity products, right? So in a way, our portfolio sort of stopped a bit, let's say slow down in terms of, giving more opportunities. Irrespective of that, because there was an interest in the market, we continued. In fact, as of today, I think we issued something like 13 bonds issuance for 1.2 billion euros, so a significant amount in the market. And the interesting thing is that we start also issuing different denominations. So we started, I think, with euros and dollars. Now it's also Mexican peso. Don't ask me why, because it's dealt by our treasury department, but also, for example, Turkish lira. So which means that we're trying to also attract investors from different geographies and interested in a wider range of products. And I think also the other experience with the climate resilience bonds has been that the interest of the investors is also directly proportional to the ability to disclose the results and the impacts. And in fact, we made a lot of effort to introduce, specific sections of our annual report to reflect on the impact associated, the expected impact associated to this type of investments. And again, Gareth mentioned the point, different with output, outcomes, and impacts, clearly reflecting all the different type of results that you can track and disclose. Maybe if you allow me, I like to also shift about the new products that are coming into the market. At EBRD, but this is shared also by other MDBs. We are quite keen on result-based finance instruments. So sustainability-linked loans, for example, and bonds are something that we like a lot. Why? Because again, offering new products in the market, The market like diversification, like customization, and the SLL in particular offer that customization. And also the way for those that maybe are not familiar with the product, is a general purpose loan with some condition attached, which can be associated to physical impact or improvement, enhancement or management practices, for example, in terms of disclosure, where the interest rate or a part of it is linked actually to achieving or not this type of KPIs. The reason we like it is because it's an instrument that gives a lot of flexibility in the way to shape climate finance or green finance more in general, but also because you can combine at the same time a physical output with indeed a behavioral change. So often KPIs include, I don't know, adoption of TCFD, disclosure requirement, introduce element. We're now trying to include TNFD type of disclosure requirement, adoption of specific market, based targets. So this combination is what, is not only the physical impact, but also the transformation that can happen at the level of an organization. Again, we are really working particularly in the private sector, not only, but particularly in the private sector. I'll give you one example, which is a company we've been financing for several years in Ukraine. It's called Astarta. It's a large vertically integrated operation. So they do farming, they do transformation, they also have logistics. And it's quite interesting because, we started the journey with this company long ago, I think back in 2007. So we started with an energy efficiency loan to modernize and improve the performance of some of their sugar producing operations. Then they did a large, biogas project using agricultural residues, which actually turned into one of the largest JI projects, for those that have been in the carbon market for long enough. And now they're embracing new type of financial instruments. We signed last year a $35 million SLL with them, which included several elements. One was about transforming 60,000 hectares of land to sustainable agricultural practices with KPIs associated to greenhouse gas emission reductions, associated to soil sequestration, but also water savings associated to no tilling or other type of sustainable farming practices. And at the same time, as a part of this process, again, looking at behavioral change, they committed to develop a climate change strategy. They committed to start disclosing according to TCFD. So, all of a sudden, this company not only is able to deliver, physical outcomes, ultimately is able to integrate, climate considerations in their business and investment decisions. So this is another good example of, how you can reach impact through, multiple channel of engagement and how the financial structure can ultimately support that.
Thank you so much, Giampiero. Great intervention again. And in addition to bonds, we can speak on the results-based financing and the different instruments we can do in this regard. And I'm sure others can also share similar experiences because it is indeed a product that is used widely by many of us. Now, coming back to Migar, and again, maybe just to think about reflecting and looking into how can we scale up this similar product? How can we have more guarantees that are deployed for adaptation projects? What are your thoughts as to whether it should be only Migar? Can other maybe IFIs also do guarantee mechanisms somewhere else? How can this be scaled up as a product used widely?
Thank you, Julia. So I think for us, so as some of you may remember, as a result of the COP27, the recommendations for the MDBs really to start looking how we can work better, how can we do things differently. The World Bank Group really went through an evolution process. And throughout the evolution process, we created something called the Private Sector Investment Lab back in June 2023, where we wanted to really listen from the different types of clients, private sector clients, but also our client countries. What can we do? How can we work better? How can we catalyze private sector financing particularly towards adaptation? But generally, how can we really use private sector money, because governments and public sector lending is not the only way going forward. So as a result of the Private Sector Investment Lab recommendations, and then there was the G20 Independent Experts Group recommendation around the use of guarantees. and how MDBs can really benefit from guarantees so that we can deploy more. So as we looked internally at the bank group and we realized we have over 20 guarantee products scattered between MIGA, IFC, and the bank. And clients used to say, why do we have to go through an IFC process and then a MIGA process, or an IBRD process and a MIGA process? So there came a decision of creating the World Bank Group Guarantee Platform that is housed in MIGA. And this platform was launched in July with a target of 20 billion by 2030. And this platform is meant to really work with one process for all our clients. How can we make sure that if a client wants a guarantee, instead of going to IBRD or going to MIGA or going to IFC, just have a one-stop shop? But then how can we work with other NDBs? So NDBs have been saying, okay, we have a challenge around our capital. What can we do? And the only way to release capital is sometimes through guarantees. So we've been working on two type of products. One is called originate to dispute. So basically, how can we use MDB money at the beginning of a project so that they can create or take on the construction risk? So an MDB or any other IFI can go there and start financing the project, at the beginning, 3 to 5 years. But then to use their capital efficiently, they can go out and then we bring in private capital, being from local financing or other forms of financing, with a MIGA, supported by a MIGA guarantee or a platform guarantee, to help offset the potential risks that are there. So the originate to dispute is one new way of thinking. The other thing is the callable capital of MDBs. So MDBs have been challenged with their, ceilings in countries. So they say, okay, we have reached our limit in country X. How can we do more? So the portfolio guarantee that MIGA is covering, and we've been discussion with all of our MDBs, EBRD, IDB, so that we can say, okay, how can we use the guarantees that MIGA is offering to offset the capital, and we cover a portfolio of your products so that you can deploy this capital in other countries or in other usage. And in that regards, we've been working with, honestly, of course, our president said, okay, we have to really test it first internally. So we've worked with the World Bank and see, okay, can we deploy this money in India? So we've had a project there where the bank had reached their limit in the country. And then with a MIGA guarantee coming with the private sector, the money were repaid. And we may need to make sure that the country, of course, benefits from an early repayment of the loan. And then the private sector money came in to fill in the gap and continue. So instead of holding the MDB capital for 15, 20 years loan, they were there only for 5 years. And then the private capital came in to work in that. So this is a way of our thinking of how we can really work with our clients and our colleagues and our partners to deploy more. I think, as you know, MDBs have been challenged, and I think Gareth mentioned the thing about sometimes adaptation projects are not about revenue. So how can we really then increase the role of MDBs in supporting adaptation projects? So these are the two things that we were thinking about to increase adaptation for us. Thank you.
Thank you so much. Excellent. And if I can pick up on one of the things you've just described here is actually the engagement with the private sector as well, right? This the innovation lab that you just referred to, and the fact that you listen to their views and tailor the product that is actually suited for the private sector so that they can come in and take on after the MDBs have actually left. So very good reference to how we actually work with the private sector as well. Thank you for that. So Gareth, back to you. Now again, looking into the future, what do you think is necessary to actually roll out the ABM mechanism beyond just what it is here right now? Any ideas about further partnerships with the MDBs or as well private sector perhaps?
Great, thank you very much. So, I mean, I think the major thing, the long-term thing we need in 5 years' time, as I said, is that I think governments in the developed world need to regulate to require all emitters to contribute to the costs of adaptation. I don't think that that's an unreasonable request in the context that we're in now. I mean, certainly in Europe, the challenge we face from migration driven through climate change is that's something that's very important to invest in to enable those societies to continue living. I mean, we see the terrible stories, about people saying, well, we get to Europe or we die because there is nothing for us here. So it's really really, it's as Yusuf said, you know, we don't want to make a conscious decision to let people die. We need to do something to address that. So I don't think it's unreasonable to think that government should regulate to require contributions towards adaptation. But as I say, that's a 5-year goal. In the shorter term, we still need to prove that the mechanism works, and that's why we're trying to raise this fund to enable us to hold calls for proposals and get a good range of different kinds of projects and technologies operating and show how that can operate. I'm pretty confident it will work. I think there'll always be devil in the detail, but I think we can demonstrate that this is an effective way. And I think that some of the attractive features are that the costs, particularly the small scale projects, because we don't have this benchmark price and we set the price depending on the project costs, it means that we can internalize all those transaction costs. So in the cash flow that lays out the amount of money that you need, you have your investment costs in the project, you have your financing costs, and you have transaction costs. And those are all eligible expenses, and also a return for the investor. For the project developer who's doing that, they need to live. So you can see all that laid out. And that's important because it means we don't discriminate against small scale projects because we know they're more expensive to do. And there will be donors and investors or buyers who want to support small scale projects. And another point about that is that we're not seeking the cheapest adaptation benefits. What we're seeking is value for money through transparency. So if you want to do climate resilient agriculture, we know that climate resilient agriculture in Kenya is going to be cheaper per household than climate resilient agriculture in Sierra Leone. That's just a fact of life, but there will be donors and funders who are happy to go to post-conflict zones or countries that are difficult, or there could be francophone countries that they want to go to or whatever. It's about transparency and demonstrating you get value for money. Now, I don't know what climate resilient agriculture costs per household now, but by the time we've done 3 projects and audited that data, we will start to get an idea, and we will start to understand why it's more expensive in some settings and cheaper in others. So I think that's a really important aspect of that. Another point about the pricing and this flexibility around the methodology. I talked to a fund manager earlier today, and she was saying that they're very interested in adaptation and creating jobs. And one of the nice things about the flexibility we have about the methodologies is that if you want particular information, you can build it into the methodology. You just need your project developer to agree to collect that information. It will have an impact upon the price, but if you're happy to pay for that, that additional price, then you can move ahead. And likewise, if you follow the logical framework where you have outputs, outcomes, and impacts, if the logical framework is strong and you're happy to pay on the basis of outputs because you believe that if you get these outputs, you're going to get 90% of the impacts, then I can pay you in year 1 on the basis of outputs, and the financing costs are much cheaper. But if you say, no, I'm not sure about this, I want to wait until year 10 when I can actually see the outputs, so I see the impacts, that's fine, you can do that, but there's going to be 10 years worth of financing costs built into the project. And that's fine. There may be donors who say, we want to have that certainty. So, these are some of the flexible aspects around the mechanism that I think will help it, gain traction and scale up. And then finally, on the kind of maybe on the rollout and where we go, we're developing it because we saw the opportunity, we see the need for support for adaptation. But we're a bank, and really we want to lend money. So we want to be a lender to project developers who have a signed purchase agreement and a registered project. There's various exit options. One is that, we end up carrying on running the Secretariat, and we have to do it at arm's length from our lending activities. And we can invite other MDBs to set up their own ABM executive committee for their continents to work in their language with their adaptation challenges. That would be one option. Another would be that we might get a global not-for-profit to take it on and run it on a global basis. Or the nuclear option would be that the UN Secretariat would say, we're going to take this on and run an Article 6.8 Secretariat like we do for Article 6.4, because it could work as an instrument under that kind of a structure. Just maybe my final point, I didn't mention others. We've done a lot of work developing templates, guidelines, and so on. And you can find all of those on our website, which is abmechanism.com. It's not a brilliant website. We've just re-recruited our webmaster, and he'll be upgrading it again. But the information, most of the information is there to find out what we've done, and we're actively developing it and moving forward. Thank you.
Thank you. I think the two things that I can take away from what you said is transparency and customization. That is very critical. You explain what the processes are, you show on what is the methodology behind it, but you also are flexible to adjust it and also customize it to what the different needs are from the different regions that we're working in. Coming back to Helen again, similar question to how the products that IDB Invest is offering with regards to adaptation can be also deployed and expanded beyond of what you do in terms of region or actors or countries. Any specific conditions that you want to highlight are necessary and the enabling environment that needs to be created for those products to be actually picked up by our clients? Thank you.
Thank you. So before I jump into the specific things that we are considering or having to look at it in detail, let me tell you that IDB Invest, similar to what Yasser was saying about the World Bank Group, we also went through a capital increase based on a change of business model. So IDB Invest is moving from originate to hold, which is what MDBs had done most of the time, to an originate to share, to basically mobilize more private capital. So the idea is that we know that there are billions or trillions of dollars of asset owners, asset managers that want to invest in ESG investments or assets, but they need to know that those assets are good and to have conduits or channels or instruments that will allow them to come to the Latin America and the Caribbean region or other regions of emerging markets. And for that, we have designed different types of products, AB bonds, AB loans, and the most recent one is a securitization of part of our portfolio. It's a $1 billion portfolio where we included different types of transactions that we had, and we were able to mobilize a lot of large asset owners that in the other ways, they wouldn't come to the region because the ticket sizes or the investments are between, I don't know, 20, 30, $50 million. And for them, they only are interested in $500 million investment per time because they don't have the capacity or the granularity to analyze investment per investment. So with that, why am I talking about this? Because when we think about this clause, the climate resiliency clause, what we saw when we were trying to mobilize in a syndicated loan of a private bank in Argentina, they could not understand the clause. So for them, actually having the clause could impact the credit rating of the company. So understanding the dynamics of the instruments that we're trying to give the countries or the clients to be financially resilient and to be able to adapt may be counterintuitive when we're mobilizing private capital. So what do we have to do? In this case, what we did was explain that this was a condition to strengthen the client and that the client was going to adopt resiliency measures. Now, what takes you to the conversation, the second degree conversation, is how are credit rating agencies looking at vulnerability and looking at resiliency measures? Generally, credit rating agencies, which is basically the basis for the price of private capital, are not necessarily taking into account resiliency as something positive. They look at vulnerability as something negative, but not resiliency as something positive. So that means that we have to talk to credit rating agencies to make them do the shift, to understand that this is something positive. So when we're trying to mobilize and when we are trying to use adaptation, we have to make the connection between the two things. Otherwise, we won't be able to get to the trillions of dollars that this COP is mentioning.
Indeed, thank you so much. I would like to turn to audiences for some questions. It has been a very, very interesting discussion, at least from my point of view, and I am sure that everybody is also very keen to perhaps hear more from us on the specifics around the innovation, the products that the MDVs are deploying. So anybody, burning questions? If you could just give a second, we will find a microphone.
Okay. My name is Kevin from the International Energy Agency, and this question is for Gareth. So thank you very much for the discussion around the ABM. Just a question about the MRV costs of your adaptation benefit units. Like, what's that like compared to carbon credits? Is it probably higher because you've got smaller scale projects at the moment? What's the like rough ballpark for your MRV figures?
Maybe we take a few more questions and
Also du hattest gemeint, der ist von der Weltbank, aber von der Untergruppe, oder wie?
Hi, my question is for Gareth also. So I come from Mozambique and we work on the off-grid side, okay? And so when you were talking and I was thinking this could be great for mini grids, okay? Because people have electricity and then they'll be more resilient as the economy grows and their lives develop. But the problem that exists in the Mozambican context is that ability to pay and affordability. So I was thinking, is it possible if the government designs a programmatic approach instead of individual project approach? And then, because then you'll have a big enough ticket size, and then we would prepare the projects. I'm thinking as I'm speaking, okay? We would prepare the projects to have revenue stream from the adaptation benefits mechanism at some point in time. But then the government, this will be done through the Mozambican National Energy Fund, okay? So it will be a government institution, and in the initial phase, they'll finance the development of the mini grids, but later to ensure that the tariff still stays lower at the later phase, when you start seeing the impacts, after the mini grids get developed, you get connections, then you would your money would come in, to ensure that over a period of 5 or 6 years, the tariff still remains affordable. And then the expectation is after some time, there's really enough development at the village side, so that people can really afford to pay. But is it possible to have a conversation like this where you involve a national fund? It's a government fund, okay? So where you involve a national fund with the idea that at some point in time, there will be another revenue stream to ensure that long-term the tariff will be sustainable.
maybe one more question from the audience before we come back to the panel. Gareth, over to you.
Thank you very much. So on the first question on the MRV, well, we haven't created any certified adaptation benefits yet, so we haven't, done the MRV for real. But it's a very good question, because we have the flexibility to choose these, and I explained about the outputs, outcomes, and impacts. And we want to choose cheap and easy things to monitor and verify. And the reason that we can do that is that the certified adaptation benefits are a voluntary instrument transacted between a willing buyer and a willing seller. They are not used for compliance against an international regulation like an emissions trading scheme. And therefore, if it turns out that you only deliver 80% of what you've paid for, or that the things aren't quite as what you expected them to be, and there's some negotiation around it, it doesn't matter. It's a voluntary contribution. The only thing that matters is that the host country continues to agree that those outputs contribute to their adaptation needs. So for that reason, we think that the monitoring and reporting will be significantly cheaper and easier than we see in the carbon markets, because we don't have that requirement of a ton having to be a ton. We can be much more flexible about that. And we do particularly want to see the deployment of smart technologies, satellite images, drones, and things like that to verify things on the ground. And that also depends on the buyer being willing to accept that level of information. And as I said, if they want more detail, that's great, they can get it. They'll just have to pay a little bit more. So I hope that makes that clear. The second example, this question on Mozambique and the mini grid. First of all, I think energy access is a fantastic adaptation technology, as is clean cooking. We tend to see them as mitigation technologies, but when you look at the impact upon households, freeing up women's time, health benefits, and so on, these are things that make households economically stronger and therefore more resilient to climate change. So I'd really love to see these kinds of technologies coming forward as adaptation projects. And we haven't yet sort of talked about programmatic, but we know that programmatic worked under CDM, and there's no reason why we shouldn't have something programmatic. And if you were able to do something at the scale of, a national program, that would then be requiring, to mobilize significant, tens of millions of dollars to cover those, then I think it would open the door to much larger financing instruments. And definitely, if you can find a buyer who's willing to say, yes, I want to support energy access in Mozambique, and I'll do that for the next year at the rate of 3 cents a kilowatt hour or something, then you can have that revenue stream. You do need to have an exit strategy. We can't continue funding the tariff forever. So, you would need to have a way to get off it. But it's entirely reasonable to say that these users need support for the first 5 years whilst they get used to it and start to benefit from the economic outcomes, outputs and impacts of having energy access. And after 5 years' time, we would expect them to be in a situation where they can then pay a cost-reflective tariff. Thank you.
One more question at the back there, Edith, please.
Yeah, thank you very much. My name is Edith Adera. There's been a discussion going on in a number of groups around how do we unlock financing for SMEs, especially in the adaptation space. Because you find with adaptation, it's context specific. The projects seem to be very small, but you need to aggregate them in a way that it makes sense to fund, because MDB tend to fund big projects, or you could do it through intermediation with national or regional financial institutions. But even those institutions are not comfortable to then fund these micro, small, mini SMEs. So what mechanisms can we think about, or that you're aware of, where you can actually either maybe have SPVs or ways in which you can aggregate these SMEs and it makes sense to then fund them? I think if you could touch on that, that would be very helpful. Thank you.
Thank you so much. I think everybody can contribute a little bit to this question, right? I will start with Giampiero.
Yeah, I have a couple of suggestions. It's a great question, by the way, because it's clearly an important element. So a couple of examples. One I mentioned before, supply chain financing, and whether, for example, the adaptation mechanism can be applied for insetting. So we see more and more a number of aggregators. For example, companies in the agricultural commodity trading space. They have an increased interest to support their suppliers, and this can be done through standard, through specific purchase, offtake agreements that incorporate elements of adaptation. And I'll give you one example of a direct experience of the BRD. We've been working with Louis Dreyfus Company, which is a large, international global trader of agricultural commodities, and they were very interested to understand the risk associated to a number of supply chains in the region where DBRD operates. Particularly, this was in Turkey, and basically worked together to do an extensive engagement with a number of suppliers. This was like wheat supply to understand in the first place to what extent climate risk, particularly in terms of water availability, but they looked into also other socio-economic type of risks. For example, associated aging population in the farming community, was about people leaving the land and moving to other jobs. So all of this was assessed, and ultimately this was it didn't necessarily in the short term triggered a different type of contractual arrangement, but certainly entailed a different way Louis Dreyfus started working on these suppliers, and in terms of they were engaging, for example, on the type of contractual, the length of some of the contract they had in place. But certainly the first step is understanding the risks, and there are definitely a number of ways this can be incorporated. And the second, incorporated in specific contractual commercial arrangements. And the second example is perhaps in the financial sector. We see more and more commercial banks in the region that are interested to understand the risk of their portfolios, and and we do have a lot of SMEs focused credit lines where we engage with banks, local banks, and help them developing the capacity to understand the risk and also direct them towards investments which have an adaptation, a climate resilience angle.
Yeah, I would complement. again, I think that the anchor company, working with the anchor company is very important for their supply chain, commercial banks, and also funds. We have examples of funds being developed in the Caribbean where their own lending or their investments are going to be SMEs in the Caribbean. And for that, we have to work with the fund so they understand how to identify companies that are having an adaptation component. In the case of the anchor company, we did work, for example, with a company in Mexico that is called Naturasol, which basically they produce granola bars. And one of the inputs that they use is honey. So what they saw when we were working with them is that they saw that their honey producers were being impacted by climate change, by basically flooding in the south of Mexico. So we work with the company, and together with the company, we work with the suppliers, with the indigenous communities that were the beekeepers. We provide them new queen bees and help them design a program that it was producing honey in a resilient way. At the end of the day, it had very good results, not only because, of course, they were producing more honey. Actually, the women that received the queen bees produced more honey and they were more resilient than the men population. We did an impact evaluation of both. But the other interesting thing was that a second flooding came around a couple of years later. And what had happened is that this engagement with the community created a loyalty to this supplier, this anchor company, because they felt that other anchor companies had left them behind. So when the new flooding came and other honey producers were not producing honey, basically the large companies came looking for this specific group of producers for honey, and they said, no, you left us behind. We only want to work with this anchor company. So that's a very positive outcome as well. Please go.
Thank you. I think just to add from Miga's perspective, I think one of the key and thank you for mentioning the aspect of context specific, because I think this is one of the really key challenges for us working in the adaptation space with our clients. Unlike mitigation, where we have a positive list of projects, adaptation is really context specific. So how can we really work with our clients first for them to understand how do we assess projects? How do we really make sure that this project is really an adaptation project rather than, a positive list of projects? So I think working with our financial intermediary clients, as everyone said, is really key. And in that regards, there are the national banks, the national development banks, and there are the regional development banks. And for us in MIGA, we've been working with both. Because when it's a national development bank, already we can go ahead and do the analysis, because sometimes banks do not have the expertise to really then go and do the climate risk analysis that we are doing at the MDB levels. But then how can we work with our donors to raise capacity of our clients and make sure that one of the key challenges for our clients typically have been around data. We don't have access to the same data. We don't find the information. How can we really assess the vulnerability context of this region in the country? How can we do that? So through our trust funds, we've been working with our clients to at least make sure that there is capacity building in that regards. Then comes the aspect of working with all our partners and see, okay, is there a way for us to share information across what we've been doing with our financial intermediary clients? Because sometimes most of these clients have worked with some of us. So they may, like Boad must have worked with African Development Bank, or Banco do Brazil with IDB. So how can we then build on what everyone is doing and make sure that our clients have access to this information, and that we coordinate and make sure that clients really understand and build the capacity to work on these aspects? Then comes the aspect of SMEs themselves. How can we make sure that they have access to some of the case studies that we have, that they can learn from other aspects or other projects? If you have, an SME client in Mozambique, how can they learn about, other agribusiness practices in other countries in the continent, or perhaps in Latin America? So sharing information and sharing case studies is really key. So for us, this is one of the things that we've been doing with some of our clients, like as I mentioned at the beginning, Boad, which is really working with agribusiness clients, and Banco do Brazil on the nuttle farming. And personally, we are also learning from these two projects. We're learning from this and we're learning from that, and then we'll see how we can bring all this together. So SMEs is really key. I think Helen mentioned private equity funds. So I think this is another thing. The one challenge for us going forward is how can we work with microfinance and raise the capacity? Because I think banks have much more capacity. Microfinance is slightly different. So how can we work with microfinance in this aspect? This is an area that perhaps we will need to look more and see what we can leverage on that regards. Thank you.
Yeah, let me just come in briefly and mention a program we have called the African Green Banks Initiative, where we're working with national scale entities to develop a capacity to become green banks. So green banks, I mean, it's a catch-all phrase, and we recognize anything from a fund that offers technical assistance and grants through to an institution that has the capacity to develop financial products and borrow money. So we're working right now with two banks, one in Cote d'Ivoire, one in Benin, to build capacity to set up the infrastructure to make green loans. So that means a governance structure, environmental, social impact assessments, gender awareness, Paris alignment understanding, and so on. And once they have that capacity, we will then work to capitalize the institution. So AFDB will put some money in. We'll go to the Green Climate Fund to get $50 million of highly concessional funding, and then we'll crowd in funding from DFIs and maybe even some impact investors and commercial lenders. But also, these national institutions have the capacity to mobilize resources with the government support through something like a carbon tax or an import tax on fossil fuels or something. And they can tap into funds from diaspora, which is very interesting, because then they have the ability to lend in both local currency and in hard currency. And that local currency lending is very important for MSMEs who wouldn't have the capacity or the ability to bear the costs of a hedging instrument. So this is a very interesting program, and we think that this can have a great potential for supporting national scale MSMEs. Thanks.
Thank you. And unless there are any burning questions, maybe I would like to offer some takeaways from this very rich discussion that we had here today. And I think 3 takeaways from my side, and I hope you're all leaving with a reimagination of what adaptation is. 1, it does take time to develop any product. So please be patient with us as we're thinking through on what are the best solutions for all our clients. But I do see a lot of progress so far with what different organizations are offering. Second one, that there is a large variety of different instruments that we can do, from insurance to debt clauses to guarantees, etc. So there is really a lot of there beyond just simply grants and loans that the MDBs can offer. And the last one is that there is a lot of potential for application. And like Gianpiero said, we are all talking to each other, we're learning from each other, we are coordinating with each other, and we're trying to see how we can maximize the products that we are offering to all of our clients. So with that, I think let's thank to the panel for this great conversation, and have a good day.